Hi there, and continue with our series of telling investors what 2012 holds in store. We get you a very special episode of Crystal Gazing with Nouriel Roubini.
Mr. Roubini, thanks very much for taking out the time. Really appreciate it. Let me begin by asking you that given the history of conflict that we've seen in Europe, do you think severely indebted nations will accept Germany and France's economic diktats? Will 2012 be the year in which the euro unravels and the union actually comes to an end?
Well, the economic and financial conditions of the Eurozone are very severe. Germany and France cannot impose their will on all the other countries because the decisions in the Eurozone are taken by consensus. The trouble with the Eurozone right now is that you have severe stock imbalances, large stocks of public debt, large stocks of liabilities of the financial system, and there are flow problems. There is a recession now starting most of the Eurozone. There has been the loss of competitiveness of the periphery of the Eurozone. There are large external imbalances. And all the policies that the Europeans are pursuing right now, fiscal austerity and similar, are going to make that recession in the Eurozone worse. So I do expect that not just Greece, but a number of other countries over the next couple of years will have to restructure their public debt and private ones in a coercive way, and I also do expect that one or more members of the Eurozone eventually are going to exit the Eurozone. If it's a small Greece exiting, that can be managed. If eventually it were an Italy or a Spain having to exit, that would be effectively a breakup of the Eurozone. So of all the sources of systemic risk in the global economy, certainly the problems of the Eurozone are the most severe.
Does that mean that you do not expect a complete breakup of the European Union or even the concerns that are coming in on the status of the euro? You think those concerns are exaggerated?
No, I do believe that over time, not this year, some of the member states are going to restructure their debts in an orderly and in some cases even disorderly way, and eventually, starting with Greece, but potentially even other countries, could exit the Eurozone. I don't expect a breakup of the Eurozone in 2012, but I would say that if you take an horizon of the next 3 to 5 years, there is a meaningful probability that a number of the member states of the Eurozone might eventually decide to exit the Eurozone, and eventually a breakup of the Eurozone is going to occur. The point is that, however, the crisis of the Eurozone is not going to be a sudden death, but it's going to be a kind of a slow motion train wreck where initial economic difficulties, then financial, then fiscal, then debt restructuring, and then eventually exit might occur, but that's going to occur in a slow motion with separate countries having difficulties at different points in time: Greece, Ireland, Portugal, Italy, and Spain. So it's not going to be a sudden collapse.
Mr. Roubini, how do you see the currency situation shaping up then? I mean, just taking a leaf from the earlier answer that you gave, the last 6 months have been the ones of dollar strength. Even though it is gradual, over the next 12 months, how do you see the dollar shaping up vis-a-vis the euro and the other emerging market currencies?
Well, relative to the euro, I would say that given the economic and financial difficulties of the Eurozone, the euro should be weakening. There is sovereign risk, there is risk of a breakup. The European Central Bank now is easing monetary policy while the Fed for the time being is on hold. And on a fundamental basis, while Germany can live with a euro at current level because it's uber competitive, the countries in the periphery of the Eurozone, if they have to have a chance to survive in the Eurozone and not exit the Eurozone, they have to have a much weaker value of the euro. The euro should be falling on a fundamental basis towards a parity with the US dollar to give a fighting chance for Greece, Ireland, Portugal, Italy, and Spain to survive in the Eurozone. Now, I don't predict that the euro is going to fall to parity with the US dollar, but I would predict that in the next few months, as these economic and financial difficulties of the Eurozone are going to become more exacerbated and the policy solutions are going to be found to be limited, that the euro is going to weaken relative to US dollar. The other point about the US dollar is that the US dollar tends to strengthen when there is periods of time of risk off and risk aversion in the global economy, when there are tail risk and there are these episodes of risk aversion deriving from trouble in the Eurozone or geopolitical risk. People tend to dump emerging markets currency, they tend to dump the euro and seek the safety of the US dollar and US treasuries, not because economic and financial and fiscal conditions in the US are very good, but just because the US is the tallest midget in the room, or the least ugly in a beauty contest, where the issue is not who is the prettiest or more handsome, but who is the least ugly. And therefore, when there is risk aversion, people go to the safety of the US dollar and treasuries. So, since I do expect that tail risks are going to be repeating themselves in the global economy, that overall might be bullish for the US dollar. Again, not because things are great in the United States, but just because in relative terms they are worse in other parts of the world.
Interesting you say that things are not too great, Mr. Rubini. So in which case, what's your view on what we've seen in the last couple of months? I mean, relatively some good news coming out. Are these green shoots, or are these one-offs which will taper away over the next couple of quarters?
I think that these good news are going to be temporary. Yes, some of the macro data of the U.S. has been better than expected, but I do expect economic growth in the U.S. this year is going to be anemic, subpar, below trend, at best 1.5% growth year over year, for a number of reasons. First of all, there are the problems of the Eurozone, and through trade and financial links, those are going to slow down economic growth in the United States. Secondly, there will be a significant fiscal drag in the United States this year because of the gridlock in Congress. Third, since domestic demand is going to be weak in the U.S. because of private and public sector deleveraging, the way the U.S. could grow faster is by an improvement is in net exports, but the trade balance of the U.S. this year is not going to improve because, one, growth is slowing down in the rest of the world in Europe. That's going to be bad for U.S. exports. Two, for the reason I discussed, the dollar is going to be stronger, not weaker, and that's going to worsen the U.S. trade balance. Three, oil and energy prices are going to remain high because of geopolitical risk in the Middle East, and therefore the oil import bill for the U.S. is not going to improve. Therefore, the net exports of the U.S. are not going to improve, and that's going to be another factor. It's going to be source of economic weakness. And finally, the U.S. consumer is still very challenged, both income-wise, wealth-wise, and debt-wise. Income is not growing very much because the labor market is improving only weakly. The wealth has been sluggish because equity market has been flat and housing prices have been falling, and the U.S. consumer is still having a huge amount of debt and debt servicing, and the process of deleveraging of the U.S. consumer has been just postponed. So all these factors, in my view, suggest that economic growth is going to be remaining anemic in the United States in the next few quarters.
Talking about the banking system in Europe, then, Mr. Rubini, European banks are, of course, shying away from lending to companies, and most of the funds loaned by the ECB are actually coming back as deposits to the central bank. The big question that everybody is asking is, how will the crisis be overcome? What can the ECB do to replicate the U.S. Federal Reserve's success in reinflating its economy?
Well, you point out rightly that because of the financial strains in the Eurozone, where sovereign and banking risk are highly interrelated with each other, because the banking risk became sovereign where the banks were bailed out, but now sovereign risk has become banking risk because a large part of the public debt is held by the banking system. Right now there is a credit crunch, and this credit crunch is becoming more severe because banks don't have enough capital, don't have enough liquidity, and they have to reduce their leverage by essentially reducing credit and disintermediating, and that's going to create more of a credit crunch. Now, the ECB is not a full lender last resort for the sovereign, but has been playing increasingly a role of lender last resort for the financial system, because without the support and the liquidity support of the ECB, the credit crunch and the deleveraging and the run on the banks will become even more severe. The problem is that the ECB is going to do more to backstop the banks and the financial system, but for a number of legal institutional reasons, the European Central Bank is not going to become a full lender last resort for the sovereigns, and unlike the Federal Reserve that has a dual mandate, growth and inflation, and has also a mandate on financial stability, the ECB has only one mandate, that is one of price stability, so there are legal and institutional constraints in the willingness and ability of the ECB to play a greater role. Yes, they're going to play a greater role, but I think that the fiscal, sovereign and financial and banking strain in the Eurozone are going to remain still severe, and there's going to be only partial willingness of the ECB to address them.
But it would require support from France and Germany, which really haven't been able to draw consensus when it comes to resolving the crisis. The European debt sales, especially by France, have met with some considerable success. Is there a sign then that perhaps we, are looking at baby steps being taken, but no conclusive result is really being reached by the European region? In fact, it almost seems like they are buying time to save their own sovereign rating. What's the sense going forward in terms of how France and Germany will be able to control the crisis by managing their own economies as well at the same time?
Well, as you said, there have been baby steps taken in the Eurozone, and the problem right now in the Eurozone is that there is a double-dip recession, not just in the periphery of the Eurozone, but the latest data also from some parts of the core shows that there is the beginning of a recession, rising sovereign spreads in some parts of the core, and a banking problem even in the core of the Eurozone. And unless you restore economic growth, anything else you do in terms of fiscal austerity and reform is not going to be sufficient. And actually austerity in the short run makes the recession worse because you're raising tax and cutting government spending. In order to restore growth and therefore make the Eurozone viable and sustainable, you need a whole series of different policies. The ECB has to aggressively cut rates, has to do quantitative easing, credit easing. The ECB has to become a lender of last resort, not just for the bank, but for the sovereign. The value of the euro has to fall another 20 to 30%. And if the periphery of the Eurozone is going to engage in recessionary and depressionary fiscal austerity, Germany and core of the Eurozone should postpone their fiscal austerity and actually should be doing fiscal stimulus. In my view, the joint probability that Germany is going to accept aggressive monetary easing, a weaker euro, and a fiscal stimulus is very low, and therefore I worry that the recession in the Eurozone is going to get worse, and therefore the fiscal and financial problems of the Eurozone are going to get worse rather than getting better.
Okay, Mr. Rubini, I want to draw your attention to China and India in particular as well. There are a couple of opinions that had come out about how there might be a possibility of a hard landing in China, and that may trigger off a cool-off in commodity prices, which eventually, after the dust settles down, will augur very well for economies like India. What's your view on how China will shape up in 2012 and the resultant impact on emerging market economies like India?
Well, in the case of China, for 2012, I do not expect a hard landing, but a slowdown of growth. But my view, I'm more bearish than consensus. I do believe that Chinese growth this year is going to be, around 8%. It is much lower than it has been in the last few years. And there is a risk of a hard landing, but that hard landing may materialize only in 2013 or 14, because this year there is a delicate political transition in China. By November they have to choose their new president and premier, and therefore China is going to do anything necessary to prevent the hard landing from occurring. The problem with China is that the growth model of China is not sustainable because it's based on net export growth, on fixed investment is now 50% of GDP, on high savings, and we have a very low level of consumption right now is only 1/3 of GDP. So unless China can consume more, save less, reduce net exports and fixed investment, and make its growth more balanced, eventually China could have a hard landing. But that's a 2013-14 story. As far as India is concerned, there's been a slowdown of economic growth in the last few quarters. The economic data are mixed. This year growth might be only 7%. That is disappointing compared to the hopes that the Indian economy could grow much faster over the long term. And India is facing a variety of issues. There is a fiscal deficit. There is a current account deficit that has to be financed. The rupee has been weakening. Inflation until recently has been rising. And more importantly, there has been a policy stalemate. A number of structural reforms have to be undertaken in order to make sure that potential growth becomes higher so that India can grow faster without causing higher inflation. But because of coalition politics, because of the fact there is a wide range of important state election coming up in the next few months, the policy has been essentially in a stalemate. An important economic and structural reform should be undertaken, have been essentially stalled, and that's not good news for accelerating economic growth over time.